This morning we're taking a good look at how the Federal Reserve works. It's a second look, actually, when it comes to handling money and the economy. Our financial expert, Randy Waesche, is here with more on that and how it affects all of us. And the last time you were on, we talked about the Federal Reserve, what they do, how important their job is, and how they affect so much in people's lives. Now we're trying to break it down as how it affects all of us.
Absolutely. And they are, first of all, they're a good body of very intelligent people. And the choices they make have a meaningful point on what we pay for a mortgage on our house, what we pay for a mortgage on our car, the rates that you get from your money market account or your CD, how they influence the economy, short and long term. It's very, very critical what the impact that they do is.
And a lot of people wonder if politics does play a role in the Fed and the Fed's decision. I would assume somewhat.
Well, they are technically, and I think for the most part, an independent body. They do not have to report their actions to the Congress and get approval.
Right.
They are, though, appointed by the president and approved by the Senate, the Federal Reserve Chairman is. And so there is some political influence. At this point in time, I think, who I think has done a good job, Fed Chairman Jerome Powell there are those who thought he has kept the interest rates too low for too long a period of time. There are those who think that the buying of the Treasury bonds that the Federal Reserve is doing to influence interest rates have been too aggressive for too long a period of time. But I got to tell you, it's a difficult job. And we came through this last pandemic very, very nicely as a result of action to the Federal Reserve.
And you're a fiscal conservative. I mean, do you think that the interest rates are too low for too long?
I think they probably should have started, or they haven't started moving them up yet. But when we start to look at the impact of inflation, I think it has gotten a little bit ahead of what the Federal Reserve is comfortable with. And so what you're likely to see is them to move interest rates sooner. And yes, I think they've waited a little bit too long.
And why does that help when inflation goes up?
So the concepts of keeping interest rates low, and the reason that they've done it lower than a lot of people want, is they're not confident that the economy can sustain higher interest rates at this point in time. And they're fearful if they start to move up interest rates, the cost of businesses doing business gets more expensive and we slow down the economy, and there's not enough legs in the economy to move it forward without the low interest rates. And now it's a real juggling act right now.
And now the one thing the lower interest rates have done, it's really helped home buyers, and at the same time hurt home buyers because the interest rates are so low, prices have been jacked up on houses, and it cuts a lot of people out of the market.
If you're in the market for the past 3 years, you're whistling Dixie for the lower interest rates. If you've had a house, you've probably refinanced it. I don't think we'll see, Eric, you and we're not going to see interest rates on mortgages for 30-year fixed the rest as low as they are for the rest of our lives. Now, you're right. Because of the low interest rates, housing prices have pushed many people out of the ability to buy a house.
Even with the low interest rates?
Yes. So you start to see when we start to see interest rates rise, those housing prices will not continue to go up to the magnitude they have. And you could easily see some downward revisions depending upon how high interest rates do trend over the next 3 years.
And what do you foresee the Fed doing in the next 6 months to a year?
So I can tell you what they're somewhat announcing in their reports. We are likely to see by the end of this year a reduction in the amount of treasuries that they're buying, treasury and mortgage-backed securities, which will allow the longer and the midterm interest rates to float higher. And I think when they first announced they're going to start to change the Fed funds rate and the discount rate somewhere in 2023, they're telescoping that we may look at that closer to the end of 2022. So a lot of it's going to depend upon how we come through the next couple months with this recovery. The Delta variant of the pandemic, I think, was what set them back further than what they expect. That's where the supply chain has really embedded inflation to the system. That's what they're looking at mostly right now.
Randy, thank you very much.
Eric, always a pleasure.